From the beautiful Finger Lakes region of upstate New York, this is the Dental Lighthouse Podcast. We take questions from anyone in the dental profession and discuss what it takes to win not only in dentistry, but in life. Business, leadership, relationships, parenting, health and wellness, money management, nothing is off limits on the Dental Lighthouse Podcast. I'm Jason Tenori, your host, and have over 20 years of experience to pull from. Learn from my mistakes and let me help you collapse time so you can become the best version of yourself. Yo, what is up? Dr. Jason here, Dental Lighthouse Podcast. Super excited. Let me brief you guys on what's been happening. It's Monday morning, and I am at a Starbucks about to interview someone that I have a tremendous amount of respect and admiration for. But before we do that, give you a little recap of the weekend. It was all sports all the time. Saturday, my 20-year-old son, Jack, had a football game at St. John Fisher's, starting at a linebacker, played out of his mind, had 14 tackles. It's just so awesome watching him play. They beat Brockford, a team that's significantly better than them. And then I coached a doubleheader on Sunday for 15U now. I'm getting old. 15U travel baseball, and we won both games. It was awesome to see my son lose, flourish those two games. He had a really good day. And now it's Monday, it's back to work. And I'm going to record a podcast here with someone that I know a lot of you guys know in your circles, but I wanted to bring him on because he is my accountant. He is my tax strategist. He is my know-all, end-all, be-all. And I really wanted to bring him on because one of the questions that I get routinely on coaching calls or from prospective clients or even in the group coaching is the when am I ready for a DSO? Should I start a DSO? And all the questions underneath that umbrella. So super excited to welcome Mr. Scott Haberman to the show. Hey, Scott, how you doing?
I'm good, Jason. How are you doing?
I'm doing really good. I don't have your bio in front of me, but let me give it a whirl here. Tremendously good looking. I think you wrote your own bio, right? That's the first sentence. Tremendously good looking.
That's right.
But been with Eide Bailly, partner at Eide Bailly, which is a national powerhouse, accounting and all things, right? Legal. I mean, you got a lot of verticals.
Run the gamut. Yep, exactly.
Yeah. And Scott and I have been working together. It's got to be 6-7 years, maybe more.
Yeah, pre-COVID, so it feels like about 25, 30 years we've been working together.
Yeah. And Scott was, we've all kind of started our practices or bought a practice, and you got a best friend from high school that's a CPA, so you're like, okay, that's who I'll have to do my accounting, and then you start to come up on ceilings of complexity where you realize, your buddy down the street maybe doesn't have the skill set to give you the best advice, and you kind of go out there and you look for other experts, and you shake the sleeves on a few things, and that's what I did, and we were lucky enough and blessed enough to get introduced to Scott. So I'm not trying to make this a commercial to use Scott Haberman, but I really value his opinion, and I want some help in unpacking some of the classic questions that we all routinely get about the DSO. So I appreciate you making the time, Scott. I'm excited to talk to you.
Yeah, absolutely. I'm excited to be here. And a lot like you, I'm a little hungover from all the kids' sports this weekend, from Friday night until late last night, sitting in the rain in sunny Colorado. Our one rain day of the year was last night. So it's good to be in a nice warm office today.
Yeah, no doubt at all. So, we don't have a formal agenda here, but let's just unpack the question that we routinely get. And I know it has a lot of nuances, but the question and maybe people don't even really know what to ask, but the question is simply, is it time for me to start a DSO? And we were talking a little bit before we hit record. It's so depends on the situation and goals and stuff like that. But I would just love to hear your textbook answer when you get that particular question, like, am I ready to start a DSO?
Yeah. It's like we were talking about before we jumped on this, it's really case by case, and it depends on every business owner's facts and circumstances. But as I like to open up the conversation with them when they're considering this route is, well, what are the plans for the business 10, 15, 20 years down the road? Obviously, there's always going to be an exit event, right? There's some kind of transition event for any business owner. And typically, dental practice owners, they're majority owners of their practices, right? And so there's going to be some kind of exit event in the future. And so what are the plans for that practice in the interim before that exit event? Is it to grow and scale beyond 3 locations? All right. Well, if that's going to be potentially on the radar, all right. Well, that's moves the needle towards, let's look at a potential DSO. That's one of the indicators. Another one I see a lot is, hey, I want to reward not only maybe my associates with equity, but potentially key team members that are clinicians. Well, you and I both know, and I'm sure a lot of your listeners know, that dental boards have specific rules, and you typically need to be a doc to have ownership in a clinical practice. And so if there's going to be either non-clinical owners of the practice that are key members, or maybe B, potential outside capital coming in down the road, where it's going to be a requirement by those dental boards and licensing boards. It depends on the state, right? Depends on the state. Arizona's completely different from New York. New York's different from North Carolina, and so forth. Those are going to be considerations that a DSO would probably be strongly looked at that time. So those are 2 of the big ones that I look at first when someone is going down that route of, hey, should I start a DSO based upon the trajectory that I'm on? But again, everyone's situation is different. But also, the DSO, the dental support organization that you may be starting, and I'm sure everyone kind of knows what the background of DSO is and what it does, but it can also improve efficiencies, right? If you have a back office that they're taking care of, HR, billing, marketing, IT, purchasing, everything, kind of under the hood of a dental practice that maybe your flagship is handling. Well, let's bring that all into one office and let's streamline all those operations. And so that'll create efficiencies there too that could improve your profit margins, i.e. EBITDA. So that could potentially improve EBITDA down the road. So a lot of things to consider just based upon where you are in your personal and professional growth journey.
Awesome. So appreciate that answer. Let me ask some follow-up questions just based on my ignorance. To your point, maybe we just need to take a step back and say basically what we're talking about with the DSO. So as you alluded to, dental service organization, it's a completely different entity, right? A completely different business and accounting entity that for the most part, talking about this at a high level, has agreements with particular clinics. So in this fictitious example, let's say that there's 3 dental clinics. They're each doing $2 million. And they have a DSO that is the umbrella over these 3 clinics. So the DSO is a separate entity. They have agreements with each of the clinics. And to your point, depending on the state laws, ownership of the DSO or the entire entity can be at the DSO level from either a clinician or a non-clinician. Is that pretty much kind of the
exactly? Exactly. And with that separate new entity, that DSO, that's the entity that's essentially running all the payroll, employs all the non-clinical payroll, owns the equipment generally, it has all the debt as well. That's where all the value of the organization actually lies, is in that DSO. And the clinical entities, if you move down that road, clinical entities are typically only receiving the collections from your patients and insurance companies, and then also paying the payroll to your clinicians. Anybody who touches the mouse generally is on that payroll. But other than that, that clinical entity is essentially a shell to collect that income and then pay that clinical payroll. And then the remainder, and this is oversimplifying it, but the remainder is paid via management fee to the dental support organization, where the value of the overall organization lives.
Right. So let me ask some follow-up questions. Just get a little bit more into the weeds here. Um, in this fictitious example of three practices, each doing $2 million, they started DSO. Um, let's say they started DSO mainly because of the opportunity for non-dentists to have a level of equity. Let's say, to your point about goals and vision, let's say that the dentist, the founder, truly has no intentions of selling. And the reason that we're considering it is two reasons. Two reasons I commonly hear on coaching calls is I'm sick of the flagship paying for everything and not being able to like figure out if this practice is supporting that practice and vice versa. And to your point about centralization. So can you just speak to those 2 points again, assuming that equity is not going to be awarded? So we're not forming this DSO for partnership reasons, but is there benefit in forming a DSO to have quote unquote cleaner books, and then just touch more on your you know uh, levels of efficiency with centralization?
Yeah. Yeah. So the cleaner books side of things, I think it just depends on, usually what I see the most is, like you said, that flagship is covering the costs of all these offices. And that's going to be most of those costs that are out there, except for maybe even payroll costs. So you got supplies, IT, everything under the sun is being covered by that. Does a DSO fix that? It forces it to be fixed, right? And so you have this overall organization that's paying for these expenses that need to be allocated down to the underlying, essentially, customers, right? Those clinics are the customers. It's just like you as a dental practice owner go to a supply rep and are making those purchase orders from that supply rep. So the DSO is essentially taking care of all of those other services other than treating the patients. They're taking care of those services from those underlying clinics. And so you have to allocate those fees to those customers. What's the markup of those fees, and how are we doing the allocation? I think it just depends on the type of practice it is, general, specialty, and so forth. And so it kind of forces you to be more transparent on your financial statements about how each practice is performing. That's for sure. And, can you get around it without a DSO? Yeah, but you're not technically forced like you are with a DSO in place. But I think with any kind of agreement that you have between practices, there are probably hurdles you got to look out for, or any kind of landmines with cost sharing between clinics, depending on the states that you're in. You could look at potentially allocating costs between the office and getting reimbursements from some of those newer practices back to the flagship office. But to answer your question, yeah, I think that DSO probably helps you a lot more than kind of doing those back of the napkin allocations to and from your offices that you have under your umbrella.
Yeah, I know that when we started our relationship with you pre-COVID 25 years ago, I think we had maybe 3 locations then, and we always knew that the flagship was kind of the life support of the other practices. But until you get it truly separated and really clean, and you see there's a particular location that lost 12 grand this month, and you're just like, whoa, at least for me, you didn't really realize it because all of the mistakes and blunders were being covered up by the cash flow of the flagship. So for me, it was just so enlightening to have clarity on knowing specifically what we needed to fix. Because at the end of the month, it was very black and white. It was like, okay, this particular location, cash flow
Yeah.
16 grand in the red. So what are we going to do about it?
Yeah.
Um, the other thing that I think was really helpful for me, and maybe you can speak to this, is um, these key employees that are shared amongst the clinic. So for me, it could be a director of operations, a director of finance, where their time is spent, could be someone like a head of HR, IT, marketing. Their time is spent not evenly, but wherever it's needed. And it's unfair to have one particular clinic or customer, to use your language, paying for these wages when they're not utilizing that service, or the
Yeah.
services are being utilized in another location. So um, do you find that having a DSO makes that level of bookkeeping a little bit easier to manage and to understand?
I think you got to be careful of the paralysis by analysis too, right? And so you got to be careful of splitting hairs about, all right, this employee is spending this many hours this month at this clinic, right? And they're trying to clean things up here. You got to be careful of that. You don't want to obviously spread the peanut butter of these wages across, but usually for a higher performing organization or a higher performing clinic and location, that one might require a little bit more time. If it's a $5 million office compared to $1 million office, all right, there's probably a little bit more time that's dedicated to those offices. So there's certain allocations that you have to look at when you're invoicing those management fees or those DSO fees. There's certain allocations you have to focus on to make sure that, all right, our marketing spend is being allocated correctly. And we can break that down pretty easily, right? But when it comes down to salaries, or something that is kind of like an overhead item, right? It's not directly traceable to that clinic. If it's an overhead item, there has to be some kind of, I think, analysis that's done before we do that allocation across the board. And so it's super, super important to look at those non-traceable items and break down that allocation. And that's typically a conversation that we'll have with clients when we're looking at that, looking at the management fee.
Awesome. One of the situations that pops up quite a bit is, founder doc, successful, decides to open up a second location with another doc, right? So I'm going to purchase this location down the street, and I'm going to go 50-50 with that doc. So the founder doc owns the flagship, and he's 50-50 partner in the other location. Now he gets this entrepreneurial bug, and he starts to scale, and he wants to start a DSO, but he's got equity already tied in at the clinical level, and kind of beating his head against the wall. Like, how do I figure out a way to either appease this 50-50 partner? Because what typically happens is the DSO wants to support that 50-50 clinic, but now that partner is like, you're charging me too much, or why are we sweeping all the profits up to the DSO? You're leaving me nothing at the clinical level. So do you find situations where you're dealing with that? And is there an easy way to transition from that or navigate that problem?
Yeah, the situation you're describing, that happens a lot. And there's a lot of different situations too that everyone's putting band-aids on it, right? They're trying to figure out, okay, what's the best way for us to move forward? Usually in that specific situation, I would look at some type of sub DSO, or that practice is essentially being it's charged at management fee, right? But then that other unrelated owner, that's not the founder, right? The other 50% owner will be an owner in the sub DSO, so they get a share of those management fees that are cut to them. But I think it just depends. You got to have clear intentions as you get into business, right? And there has to be some type of analysis that's done, an agreement made before those management fees are done with those docs who are owners, because rightfully so, they shouldn't own a clinic that essentially is worth nothing, right? They should have some kind of ownership in the cash flow of the underlying investment that they made. And so whether it's like a valuation of services of the business, okay, the value is this, so the management fee needs to be that. Maybe that's maybe an angle that you take. And so I think it just depends on the situation that you're encountering. But for sure, that doc, there needs to be an agreement set up beforehand before you start implementing management fees. It's got to be spoken to in all the legal agreements, because as you know, in business, it's a lot like marriage. You got to start with kind of the worst case scenario. Okay, crap. If we get divorced, what's going to happen? What's going to happen with the kids?
Right.
What's going to happen to the house? And so that needs to be clear up front. And that's where probably the management fee needs to be agreed upon too at the start.
Right. Awesome. This has been super helpful for me, Scott, and I think it'll help a lot of people get some clarity on if this is something they should take on. I got one final question that I hope is not overly confusing. It certainly won't be to you, but it will be to me. So let's use this fictitious example again, right? We got three practices, they're doing $2 million each, and they decided to do a DSO for all the reasons that we talked about. What if it's one practice doing $6 million? Is the only reason that this one location, $6 million mega practice should start a DSO is if they want non-clinicians to have a level of ownership? Is asked another way, if that's not even a concern, is there any, I hear this a lot and I don't have any idea if it's true or not, is there any advantage from a tax perspective of taxing profitability at a DSO level versus a clinical level? Like is the again, this is just my ignorance speaking up, is the tax bracket at the DSO level lower than it is at the clinical level? Does that make sense?
Yeah, it does. It does. Yeah, you essentially have two different businesses, right? You
Right.
have a clinical business, and then you have an overarching support business. And we've looked at this quite a bit with our national tax office. And I think generally, no, there's no difference between two entities. And just to give you my perspective on my soapbox, I think the government needs to simplify things. And why are we structured as S corps, partnerships, C corps, all these different options, right? It seems like it's just Job Security Act for me, for some of what I do during the day. I think it just adds a level of headaches for business owners that doesn't need to be there. But I'll get off my soapbox now. There are arguments to be made, and we had an internal call about this a few weeks ago, where potentially there's an angle, and don't take this as tax advice or legal advice, but there is potentially an angle where if this overall control group that's owned by a clinician is managed by that clinician, and everything is essentially owned by one person, majority owned, that you could say, okay, this support organization could qualify for that 20% business deduction, right? The QBI deduction that came out in 2017. If you have those underlying clinics taxed as C corps, this top level one is taxed as a pass-through partnership, S corp. The IRS hasn't ruled on anything like that before. And this is something that was looked at when the new tax law came out, but I think we looked at it and said, okay, well, this is all part of a control group. So IRS would come in and say, no, we can't say this is eligible. This DSO is eligible for that 20% deduction because it's all owned by one person. It's essentially just saying, hey, it walks like a duck, talks like a duck, must be a duck, right? But I think that is something to look at in the future. Now, I haven't seen any what's called private letter rulings or any case law about the IRS challenging anything like that. But I suspect that's something that we're probably going to look at a lot more closely with our clients, where the clinician is the owner of the DSO. There is an argument to be made, and I've been making that argument for some other larger groups that I support that are not owned by clinicians. The clinician might be a minority owner of that DSO, but there's non-clinician owners of the DSO. Well, there could be an argument to be made that this is eligible for that 20% deduction. So your effective tax rate goes down from 37% to to essentially 30%. So there's some tax savings there potentially. But again, I think it's all case by case basis, right? And how aggressive folks want to be, and really just trying to protect yourself from overpaying too much in taxes at the end of the day too.
Yeah, no doubt. I appreciate that answer. I mean, and again, I think you're just supporting how nuanced it is, and it would be nice if the tax code was a little bit more black and white, but that's what keeps you up all night, right?
It does absolutely. Everything's different. Every situation's different. I wish we were just putting numbers in a box and moving on, but there's days where that's not the value that we provide, right? The value we provide is the guidance and managing that overhead, because taxes, it's an overhead, right? It's something that I don't like paying any more than you do or your listeners do. I told one client before, and I think he really appreciated it. And I hope no IRS agents are listening, is my job is to increase the national deficit with my clients. That's my job. Not good for future generations, but that's why I'm here.
Well, I appreciate you doing your job well, at least for me personally. So
I try to.
Scott, yeah, I know you're busy. I don't want to take up any more of your time. This has been super helpful for me, and I hope that at a high level kind of answers some questions that I know a lot of my listeners and private coaching clients have had. If any of them want to reach out to you and have a conversation or just shoot you an email or correspondence, what's the best way to get a hold of you?
Yeah, just give me a call, 970-999-8932. That's my landline. Doesn't accept text messages yet. And then my email, Haberman at Eide Bailly, SHABERMAN, Eide Bailly, EIDEBAILLY.com.
Yeah, and we'll put that in the show notes so people can just copy and paste it from there. So again, Scott, thank you so much for your time. So appreciate your insight and your expertise.
All right, right on. Thanks for having me, Jason.
Thank you. That wraps up another episode of the Dental Lighthouse Podcast. You have a choice today. Choose to be a lighthouse. Lighthouses are powerful and steadfast. They are beacons of light for others to reference when life gets turbulent. Go out into the world today and become a lighthouse for someone. Give more than you get. True joy comes from serving others. Start today. I'm Jason Tenori, your host. Thank you for listening to the Dental Lighthouse Podcast. For more information, podcast show notes, or links to anything that we have discussed today, please check out our website, thedentallighthouse.com. We would love to hear from you. If you would like to get on the show, please email us at podcast@thedentallighthouse.com.